Hello and welcome back to CFI Deeper Dive. So far in 2023, we have had a whipsaw in market sentiment as traders and investors wonder if the US Federal Reserve and their counterparts are looking to slow down the pace and size of policy rate hikes. This week, all eyes were on the FOMC minutes released on Wednesday from their last meeting. The tone was more dovish than expected, and we can see here that US yields fell as a result. The yield curve bull steepened, which signifies that the market has gained more confidence in back-end or long-term rates due to a better economic outlook. Equities markets also steadied a bit after the large sell-offs from earlier in the week, as the market seems to take the more dovish tone as a bit of reassurance from the Fed. However, many of you may still wonder, what is the Fed and the FOMC, how are they represented, and how do their decisions impact markets? The Federal Open Market Committee, or FOMC, is a policy-making body within the Federal Reserve System of the United States. The FOMC is made up of 12 members, which includes the 7 members of the Board of Governors of the Federal Reserve System and 5 Reserve Bank presidents. The chairman of the Board of Governors serves as the chairman of the FOMC, and the president of the Federal Reserve Bank of New York is always a voting member of the committee. The FOMC meets several times a year to discuss and analyze economic and financial conditions in the U.S. and determine the appropriate course of monetary policy. The committee sets targets for short-term interest rates and decides whether to buy or sell government securities to influence the money supply and achieve its goals. Majority rules in these votes, and dissenters are noted. Members have varying views on current market conditions, with doves more focused on the labor market and hawks prioritizing inflation risks. Here we can see a high-level breakdown of the viewpoints of different US Fed policymakers. The decisions made by the FOMC have a significant impact on financial markets, including stocks, bonds, and currencies. For example, if the FOMC decides to raise interest rates, it could cause bond prices to fall and in turn cause stock prices to fall as well. Similarly, if the FOMC decides to cut rates, it could stimulate economic activity and cause stock prices to rise. An analogy for the FOMC might be that of a group of doctors who are responsible for setting the dosage of medicine for the entire economy. They need to balance the need for medicine to stimulate growth with the risk of side effects such as inflation and acid bubbles. The latest Fed minutes can be thought of as a report from the doctors regarding the status of the patient and the potential direction of treatment. The release of the FOMC meeting minutes is closely watched by investors and traders in financial markets. The minutes provide insight into the committee's thinking and help market participants anticipate future policy decisions. For example, if the minutes suggest that the committee is becoming more dovish or less likely to raise rates, it could lead to a rally in stock prices. In the most recent Fed minutes, Federal Reserve officials acknowledge that inflation is decreasing, but it'll still require subsequent interest rate hikes. Some members wanted a 50 basis point rate hike to help bring down the target range quicker, instead of the more gradual 25 basis point alternative. It looks like the market is still pricing in a 21.2% chance of a 50 basis point hike in the upcoming March meeting. That being said, there are still a lot of important economic releases leading up to the meeting that could sway this percentage, such as the PCE data on Friday, which the US Fed looks at closely as an inflation indicator. In our free Economics for Capital Markets course, we look at the US Fed, the FOMC statements, and minutes, along with an exercise on interpreting the tone. Make sure to check it out if you'd like to learn more. Thank you for listening, and we'll see you on the next CFI Deeper Dive.